This is an example of how to use the Can I Retire Yet Pro retirement calculator to analyze and plan your path to retirement. We'll look at a couple in mid-career, analyze their financial situation in depth, and see what the calculator says about when they could retire and how long their money would last. We'll start by entering information about the individuals. For you, we'll say the start age is 45 years, work income $90,000 annually, hoping to retire about age 60, and expecting Social Security of about $24,000 annually. And that Social Security, we're going to try to delay it until age 70. And then we're going to work a little bit in retirement, making around $1,000 a month, so $12,000 annually. And we'll stop working completely by age 70. For the spouse, their starting age is 40. Work income about $60,000 annually. They're going to retire or try to around age 60. Social Security income $12,000, expecting about $1,000 a month, and that's going to start at age 62. If you don't have a spouse, you can simply leave all these fields blank and it won't affect the calculations. Next, we'll work on asset classes. These are the different types of investments you can hold. What distinguishes them is their performance and volatility. The calculator breaks investment return down into 4 pieces. You can get these numbers from a mutual fund company or online sources like Morningstar. So we're going to create an asset class here called Balanced Fund, and this will model a typical balanced mutual fund. We'll guess at a dividend return of about 2% annually and a realized return of about 1%. These would be capital gains distributions that you receive usually at the end of the year, and an unrealized return of about 3%. So that's an overall 6% return for this fund. And we'll use this new asset class in a moment when we define our accounts. Next, we're going to set our starting account balances. For taxable investments, we'll say they have $50,000. And we'll just have a simple asset allocation here with an average annual return of, say, 4%. Okay, for your tax-deferred investments, we'll say you've got a balance here in your retirement account of $250,000. And we will do a multiple asset allocation here. We'll say that's 50% stocks, 50% bonds. And we're going to rebalance this annually. So every year, that percentage of stocks and bonds will be trued up to be 50-50. The program will take care of that automatically. Lastly, in tax-free investments, we'll say there's a balance of $100,000. And here we'll use our new balanced asset class. So we'll zero out stocks and bonds. And for the balance fund, we'll say it's 100% that investment. Okay, next we're going to go into events and define various financial events that happened to this couple during their lifetime and during the simulation. First of all, we'll deal with their main residence, their home, and we're going to say they bought this about 10 years ago in 2007, and they'll keep it for the duration of the simulation. And they bought in a highly appreciating area, so there's going to get some extra inflation in that home of 2%. And mortgage payments are going to come out of the cash account, and let's say they bought that for $300,000. And during the closing, their extra costs were 5% of that. And they financed 80% of that cost, and they got a 4% rate on that. And their mortgage term is just a standard 30 years. All right, and they expect to pay property tax each year of about $5,000. And maintenance costs, they're kind of do-it-yourselfers, so they're going to get by with about $2,500 annually. Next, we're going to define their living expenses, and these will also go on for the duration of the simulation. And note about the inflate before and after. This is whether the amount that we put in should increase with inflation, both before it starts in the simulation and after it starts. And in this case, we're going to keep both of those on. And we'll say it costs this couple about $6,000 monthly to live. That doesn't include their housing costs. And we'll set that for monthly. And those expenses are to come out of their cash account. Next, we'll define some tax-deferred retirement saving. And we'll have this go for, about 20 years up till 2037. And we will say that they're going to try to save about $2,000 monthly into their retirement account. So that's monthly, and that's going to come out of their cash account where their paychecks are deposited and go into their tax-deferred investments. And next, we'll put in some college education expenses for their only child. And we'll say this is going to start about 20 years off in 2027, or about 10 years off, and it'll go for 4 years ending in 2031. And they expect those college expenses to increase faster than the rate of inflation, so we're going to put in an extra 2%. And this is a private college we're considering, so we're going to say about $75,000 annually in expenses, and those will be paid out of their cash account. So as we said, this was a private college, so we'll just add that to the label so we remember. We're talking about private education here. Okay, and you see a few other events in the list that we're not going to fill out right now. There's a business or self-employment or a earned income event that lets you have more accurate handling of paychecks and self-employment if you want to fill that out. A potential annuity, this would be down the road, an annuity or a pension that pays you a certain amount every month. And possibly inheritance, and that's just a one-time deposit event. These are all optional. You can leave them empty and they won't affect the simulation. Next, we'll make a couple changes to the global settings before we actually run our calculation. We will dial down the inflation a little bit. We're feeling optimistic about that. We'll say 2.5%. And we'll run this simulation for 50 years since we're starting this couple in their 40s. And we'll take a look at output in today's dollars. That means it's going to show numerical or money results with current purchasing power. Okay, let's go ahead and tap on reports. This is going to automatically run the simulation, and we'll take a look at our cash flow table here. And each row here is showing us a year in the simulation. We see your age and the spouse's age. Then we see a number of tax statistics, your adjusted gross income, taxable income, the actual tax you owe, and then some very important rates for tax planning, your marginal rate that you pay on your last dollar of income, and your overall effective rate. Next, we see account balances for all your accounts over time. And then in the last column, we see your net worth, including your ending net worth. Now we'll come over and look at the net worth graph, and we're seeing the same data but in a visual presentation. And we can see that things aren't looking too great for this couple. Their net worth is headed steeply down. By their 80s, they only had about $100,000 left. So we might want to look at what they can do to improve their situation. So what we'll do is we'll go up and add another event to take a look at a slightly different scenario. And this is going to be a new withdrawal. And we're going to take a look at public college instead of private for their only child. So we'll rename it just to keep track of things. And we'll go in there and adjust a few values. The starting year will be about 2027, few years off when their child was college age. It's going to end in 2037 after 4 years. 2031, that is. And the withdrawal amount will be, say, only about $10,000 a year. They think they can swing it for that much in a public college. All right, and then we're going to go up to the private college education, and we'll disable that event. So the data is stored, but it won't be used in the simulation. Instead, we'll be looking at the public college. And now we'll go back and rerun our simulation and take a look at our report to now, cash flow report. And now we're seeing that their ending net worth is in the millions, so it's quite a bit more encouraging. And on the net worth graph, we see the same image. Their net worth is rising over time, giving them some confidence about their retirement. Okay, so we've seen a simple example of how to use the Can I Retire Yet Pro retirement calculator to analyze and plan your path to retirement based on a hypothetical couple in mid-career. We entered data for the individuals, their asset classes or investments and accounts, and then we defined some financial events occurring in their life and analyzed the results. Finally, we saw how to enable and disable events so we could analyze different financial scenarios. Can I Retire Yet Pro is a high-fidelity personal financial model that can analyze complex retirement situations with accuracy. You can start simply and add information as you go along, refining your own path to retirement. Go ahead and give it a try now.